The Chinese economy grew by 4.8% year-on-year in the first 3 quarters of 2024, slightly shy of its around 5% annual growth target. This disappointment mainly came from the weaker-than-expected domestic consumption. The contribution from consumption to growth has declined from 82% in 2023 to 49.9% in 2024. External demand, however, strengthened. External demand has accounted for over 20% of China's economic growth in 2024. Since late September, Chinese authorities have unveiled supercharged stimulus measures. The massive stimulus has begun to translate to improving economic sentiment. Recent data indicates that the economy is on track to achieve a growth exceeding 5% year-on-year in the last quarter of this year, resulting in an annual growth rate of about 4.9%. However, this recovery is uneven. China's GDP deflator has been in negative territory for 6 consecutive quarters. In addition, corporate has been increasingly more cautious about the leverage. As such, we anticipate further policy support from the Chinese government in 2025. China concluded both Politburo meeting and Central Economic Working Conference in December 2024. There are 4 notable shifts in the policy tone from the Politburo meeting. Firstly, the monetary policy stance will shift, being moderately loose, marking a significant departure from the prudent monetary policy regime in place since 2011. We anticipate the PBOC will lower the 1-year loan prime rate by 40 basis points in 2025 and reduce the reserve requirement ratio by additional 100 basis points. Secondly, fiscal policy will become more proactive, signaling an intensification from the current proactive fiscal stance. The last instance of a more aggressive fiscal approach was during the onset of COVID-19 pandemic, when China raised its fiscal deficit target. Similarly, we expect the fiscal deficit target for 2025 to increase to about 4%, which will create incremental fiscal spending about 1.3 to 1.5 trillion yuan. Additionally, the issuance of the local government special bonds and the long-term special bond is likely to expand. A CNY 2 to 3 trillion additional spending is needed to counter any potential impact of changing external environment in 2025. Thirdly, for the first time, the policy language included the term extraordinary to describe the counter-cyclical adjustment, signaling a readiness to employ bold and innovative measures. This opens the door for potential large-scale interventions, such as the stabilization fund for both property and equity markets. Fourthly, the policy explicitly mentioned maintaining stability in both the property and equity markets, with the latter being included for the first time. So this highlights policymakers' intent to strengthen the wealth effect, boost investor confidence. Overall, the new economic framework for 2025 has been established, providing a strategic direction for policy priorities. We still believe that China is in the whatever-it-takes mentality, coming into support for growth in 2025. The market now awaits detailed numerical targets to operationalize its new framework. One of the key risks for China in 2025 is Trump's trade policy. For Asian investors, China's reaction to the potential trade war 2.0 may have profound impact on the region. During Trade War 1.0, China adopted a trading time for space strategy, offering concessions to mitigate Trump's intention. However, in Trade War 2.0, with a clear willingness to employ tariffs, this approach may no longer be effective for China. Instead, China may target Trump's capacity to wage a prolonged trade war, which is inflation. So we believe China's response could focus on 2 key areas: expanding domestic demand and reducing subsidies for overseas consumers. By exporting inflation, China could directly impact U.S. consumers and business, applying political and economic pressure on the Trump administration. This shift suggests that the era of subsidizing overseas consumers through the fiscal tools is nearing an end. On currency, Renminbi depreciation is effectively a subsidy to US consumers. A stable renminbi might better serve China's interests in Trade War 2.0 by preserving its ability to export inflation while minimizing domestic economic disruptions. However, exporting inflation was likely to create global ripple effects, exacerbating challenges for other economies and heightening market volatility. To sum up, with emerging external risk, we expect Chinese economy to moderate further in 2025 despite more policy supports. Nevertheless, we expect China to step up its policy supports given 2025 marks the last year of China's 14th five-year plan. Overall, we only expect China's growth to moderate slightly to 4.8% in 2025.